this video, I'm talking about 7 disposable income mistakes that you want to avoid. Hey everybody, it's Matthew Jackson here from 401k Maneuver, where we provide online professional account management with the goal of supercharging your 401k performance. So stop leaving money on the table each and every year in the form of lost returns. Let us help you. If you're new here, be sure to hit the subscribe button, and the links to everything that we mentioned in this video you can find in the description box below. So let's jump right in. If you have income left over after paying taxes, it's really important to avoid common disposable income mistakes. However, there's a big difference between disposable income and discretionary income. So let's talk about it. Disposable income is your personal income minus your current personal taxes. For example, if you make 60 grand a year and you pay 20% in federal, state, and local income taxes, you now have 48 grand in disposable income. According to the OECD Better Life Index, in the United States, the average household net adjusted disposable income per person is about 45 grand a year. Now, some make the mistake of seeing an average of $45,000 a year as an excuse to spend 45 grand a year. However, it's not disposable income that determines your lifestyle. Instead, it's your discretionary income. So let's go back to the example of $48,000 in disposable income and take out all other essential spending like housing, food, utilities, insurance, and some of the other necessities that we have. The remaining money after all of these essentials are covered is what's called your discretionary spending. In other words, the best way to avoid disposable income mistakes is to distinguish between your disposable income and your discretionary income. If you spend your disposable income as if it's discretionary income, you may find yourself in a pickle. So don't squander your discretionary income. Instead, avoid these 7 common disposable income mistakes. First, not budgeting. At the top of the list of disposable income mistakes is the lack of budgeting. As I talked about before, a lot of people mistakenly treat disposable income like discretionary, and essentially they just throw it away. Instead, budget your disposable income. You want to account for all of your essentials such as transportation, insurance, mortgage, utilities, and then any other school debt that you might have. The leftover number is discretionary. So instead of treating yourself to lunch every day or buying a new phone every time a new model hits the market just because you can, budget your expenses. Because these little splurges add up if you aren't careful. So we're not saying you shouldn't enjoy your hard-earned money. We're just saying you should budget for fun and extras. And don't forget to account for all entertainment and shopping, and stick to it. Number 2, not paying attention to credit cards. Some people believe credit cards are dangerous, but it's how we use them that results in disposable income mistakes. Credit cards make it easier and safer to shop online, which is how most millennials are shopping according to Global X. Credit cards, well, they also help build your credit score. But too many people get themselves into trouble when they use their credit cards to buy more than they can actually afford. So if you're not regularly paying off credit cards each month, you'll wind up spending your disposable income on the interest. Also, many people fail to research credit cards that work best for their personal needs. It's wise to compare interest rates and reward programs for credit cards before signing up for one. This ensures that you get the credit card that works best for your lifestyle. It's also worth asking if your credit card company will offer a lower interest rate. If you have a good credit history and you pay on time, they may actually lower your rate. Number 3, misplaced spending. You may have more disposable income because you no longer have to pay for a mortgage or have kids at home. Or you may have more disposable income because you're a millennial. According to a Pew Research Center report, after bottoming out in 2011, incomes are rising for American households, and those headed by millennial, which is someone aged 22 to 37, now earn more than young adult households did at nearly any time in the last 50 years. And 43% of millennials reported making a little or a lot more money than they actually need to cover their expenses. However, a report from Epsilon found younger generations aren't shy about spending. Go figure. The real disposable income mistakes begin with misplaced spending. And this comes in the form of either large luxury splurges or a series of small hobby splurges. We've all experienced that, I'm sure. Some people feel as if they actually deserve the luxury items such as boats or timeshares because they've worked hard for their money. But these luxury items can actually cause people to spend even more money, such as having to cover additional costs beyond the purchase price, like maintenance and insurance. It's not just large misplaced spending that becomes disposable income mistakes, it's also spending money just because you can. For instance, adults with disposable income are a gold mine for toy marketers. According to Zavoria, with more disposable income than ever before, millennials are deciding to use that income to treat themselves to new toys that tap into their sense of nostalgia and that provide them creative ways to ease their high rates of stress and anxiety. This has led adult millennials to invest hundreds of dollars every year on toys. This phenomenon has led to the creation of Lego sets designed specifically for adults and Fisher-Price Little People special collector sets such as He-Man and the Masters of the Universe, created to appeal to adults' sense of nostalgia. Better beware. Number 4, not preparing for emergencies. One of the biggest disposable income mistakes is not using extra cash to build an emergency fund. Instead of using the money left after essentials have been paid for emergency savings, Americans spend money on here and now, like entertaining and everyday splurges. Number 4, not preparing for emergencies. One of the biggest disposable income mistakes is not using extra cash to build up an emergency fund. Instead of using the money left after essentials have been paid for emergency savings, Americans spend money on the here and now, like entertainment and everyday splurges. A Go Banking Rates survey found 69% of Americans have less than $1,000 in savings. Now, as 2020 proved, it's critical to save for emergencies. Hopefully, another global shutdown won't happen again in our lifetime, but you never know when you will lose a job, face a natural disaster, or experience a medical emergency. So when creating a budget, factor in using some of your disposable income to build up your emergency savings. Number 5, not planning for the future. Another disposable income mistake is not planning right now for your financial future. The earlier you start paying yourself first, the better. So let's say you're in your mid-20s. If you ignore your 401k now and fail to at least get the employer match, you may miss out on a lot of money come retirement. So let's run the numbers. Let's just say you earn 50 grand a year and you put 10% in your 401k with the employer matching it at $2,500 a year. If your 401k earns an average 8% return, your 401k can reach over $2 million after 45. Start investing in your future as early as possible. If you've waited, take advantage of a catch-up contribution limits like those that are available for those that are 50 and older. Hey, make sure you check out the description box below and read the related, can I really catch up on retirement if I'm over 50? Number 6, not prioritizing your own financial health. One of the most common disposable income mistakes is not prioritizing your own financial health. Instead, many people spend their disposable income taking care of the financial needs of their kids or their grandkids. A survey by Empty Nesters found, according to respondents, nearly 40% are still financially supporting their children in some way. And of those parents, they actually spend an average of $254 per month on their child or their children. And some of the top expenses that people say that they actually still pay for, they include the cell phone, rent, groceries, and student loans. So as much as you want to take care of your loved ones, you must pay for yourself first and make sure your financial health is on the right track before you actually take care of somebody else. If not, it could backfire and your loved ones may be stuck helping you cover expenses later in life. Number 7, spending beyond your needs. The last in our list of disposable income mistakes is spending beyond your needs. As I talked about earlier, people often confuse disposable and discretionary income. However, the danger doesn't end there. Even if you have a decent amount of discretionary income, it doesn't mean you should spend it carelessly. A common example is home buying. When you apply for a mortgage, you may be approved for a home loan that's actually more than you need. Rather than maxing out and buying a home at the top of your budget, choose to live within your means. And that includes covering all of the essentials, savings, and lifestyle needs. Only after you have budgeted your disposable income should you consider a new home loan, an auto loan, or other major purchases. Hey, we regularly post videos and financial updates for your benefit. Make sure you check back for our next freshly posted content. Have a great day, everybody.